Just the idea that they are investing so much more in capital expenditures. They're talking about $30 billion this year, $33 to $35 billion next year. And when you compare that to Chevron, one of their top competitors, they're putting $18 to $20 billion in CapEx this year. Is this the right time to be kind of doubling down on a lot of these bets?
I think it is. As he mentioned, this is a low-price environment. The cost of rigs, the offshore rigs, have been basically cut in half from 2 years ago. I mean, you want to be buying low and selling high, and over the past few years, Exxon Mobil had actually been doing the opposite. I mean, they probably paid at the top of the market for XTO Energy, for example, a big natural gas shale play, which hurt them a bit, which hurt their earnings. And the company had seemed to be in a sort of a funk, Becky, to be honest with you, over the past couple of years. But this new CEO is doing some things. They're actually going to get more active in trading as well. So I think that it's a good future. I think it's a great move for them.
When you listen to Darin Woods, it does sound like he is taking the long haul view, the big picture, and he's looking to make sure that this company is doing the right thing over decades, over years and then decades. But right now there is a little bit of pushback from some investors who say, look, where are my shareholder returns? Where are the share buybacks?
Well, the oil business is a completely different animal than, say, cloud. Or making phones, you know. I mean, they're not sitting. They need to deploy their piles of cash to be able to replenish their reserves. I mean, they're pumping stuff out of the ground that's gone. And it's not like a farm either where you can replant next year. You got to go find new sources of supply to stay on top of your game. So it's incredibly capital intensive. With Exxon Mobil, you're talking about the law of big numbers by probably the biggest order of magnitude of any company out there. So they have to get big projects on the board to, again, meet their earnings targets and growth. So it's a capital-intensive business. There's no two ways about it. One thing he's absolutely right about, and you know, we talk about China potentially faltering and slowing global economic activity, and that does affect the commodity price in the short term. But demand is steadily increasing. I mean, we're pushing on 100 million barrels a day of demand consistently. We continue to see maybe demand growth gets ratcheted down, but it's still demand growth year in and year out here pretty consistently as far out as you can see, especially in the emerging markets like China and India.
So what does that mean when you hear things like the new Green Deal here?
Well, it's interesting. You asked him about political risk in Guyana, and you know there's some political risk here too. If you look at Colorado, for example, there's a big effort underway there to potentially clamp down on their oil and gas industry and oil and gas drilling. So also too, to the extent that I can't imagine the new Green Deal coming into reality anytime soon, but yeah, that would be a negative.
And Woods did acknowledge that. I mean, you think, okay, the U.S., that's got to be a much better place to be investing than someplace like Russia or some of the places in the Middle East where they've seen investments kind of go awry. But he said, yes, we have political concerns about everywhere, including the United States. And he did talk about what they're doing to try and bob and weave around the edges in terms of looking at changes, new ways of coming up with energy, more effective ways, and they've got a lot of plans. We'll talk about that a little later in the show too. When it comes to where you see oil prices headed, what do you think? They say they don't really follow it on a case-by-case basis. They have to be willing to deal with it no matter what the market comes back.
Yeah, and really a fortress balance sheet for that, and as well, an incredible statistic yesterday from the presentation. They're profitable with double-digit returns in the Permian at $35 a barrel. They're the only ones, I can tell you that. When prices get down around $50, most of the companies are in the red zone. And even Chevron, I guess, yesterday was talking about a $51 sort of number that they need.
I read that $51 a barrel number from Chevron a little differently. It sounded to me like that's the number they need to hit in order to make all of the CapEx spending that they're doing and the share buybacks and dividends to make that all and still be able to handle it and be a profitable company. And I thought that was around all of their investments, not just the Permian Basin.
Yeah, I didn't mean to suggest that. I just meant that as far as just Exxon being able to make that much double-digit returns on $35 oil in the Permian, incredible statistic.
Is that the case, though? Is this a game of scale when you look at the Permian Basin at this point? Do you have to be big in order to really be able to be one of the big players and make it that profitable?
It seems to be the case because the smaller independents are hurting almost to a company. There's also other issues out there now. It's been coming out about decline rates on some of the wells, some of the ways that they're handling the asset there in terms of putting wells too close to each other, problematic. So, you know, it's very important that to be able to have the scale to be able to drive those costs down, because in the near term, getting back to your original question, I do see prices heading back down. The slowdown in China is going to be particularly impactful. The slowing global economic conditions, very negative for oil prices, especially as U.S. production continues to ramp up. We're now at 12.1 million barrels a day. There are pipelines that are going to be coming online here later in the year that's going to get our exports pushing 4.5 million barrels a day potentially. We're already at 3. We've had last week or 2 weeks ago, we had 3.6 million barrels going out to the international market. So there's big time pressure out there on all the oil companies and the oil market from this surge of U.S. supply in particular.
Is there anything that OPEC and Russia can do about that?
Well, right now they're willing to cede market share to support the price and to support the market, the Saudis in particular. The real battle is going to be at some point, do you go scorched earth, open the spigot, and then see how long Exxon Mobil and the rest of them can last with Permian prices down around $35 or lower? Squeeze out the high-cost producers. That's what it's going to have to take.
Wow. How long would they have to do, and who do you think the ultimate winner would be?
Well, Saudi Arabia, for sure, is the lowest cost producer by far in terms of what it costs them to get a barrel out of the ground.
What is it, like $12
It's a couple
or
dollars?
something?
No, it's in single digits. Huh. So nobody can compete with that. It's sort of like Rockefeller's beauty rose theory,
but
right?
the Saudis can't compete with that either because they have too many needs at home that they need to be funding that they can't do it at 12, or at single digits or at 12 even.
It would be a gut check for them, Becky. But again, they're going to. Their only other choice is to keep ceding market share to the U.S., and at some point there's going to be a throwdown, I think, on that front. But that's a ways off.